So how do mortgage rates work? The answer is most people don't have any idea. There's so much misinformation that floats around. I heard a lot of people around election time saying, "Hey, well, I think once Trump gets into office, he's going to drop mortgage rates." That's not how it works at all. First of all, the Federal Reserve is the main entity that controls rates in general, right? They control the rate of interest that large banks borrow from them at, right? And that sort of trickles down into the economy. Um, that does not necessarily directly impact mortgage rates either. It's a very complicated. It's not as simple as most people think it is. The president does not really have any direct control over consumer interest rates. That's the first point that I'd like to touch on. The second thing is the federal funds rate, which is what the Federal Reserve, Jerome Powell, actually sets. That also does not translate directly into mortgage rates either. There have been times last year. There were times last year where they decided to drop the federal fund rate, and mortgage rates actually went up. It gets very complicated, but just as a 30-second Reader's Digest version, the government issues bonds, right? They issue treasury bonds, which is it's essentially a loan. When you buy a treasury bond, you are loaning your money to the US government. They are agreeing to pay you back at a fixed rate of interest for a certain amount of time. There are 2-year bonds, 10-year bonds, 30-year bonds. Mortgage-backed securities are another financial instrument. They are not issued by the US government. They're issued by financial institutions that pool a bunch of different mortgages together that are similar in kind, right? You might have a bundle of 5,000 conventional loans with a certain amount of equity and an average certain credit profile, right? Those mortgage-backed securities inherently are more risky than treasury bonds, right? Because if you think about it, the consumers are more likely to default on their loans than the US government is likely to default on their loans. So inherently, a mortgage-backed security needs to pay more than a treasury bond to offset that additional risk of default, right? So if treasury bonds are trading at 5%, they're paying, if you can invest $100,000 into US treasury bond backed by the federal government, and it will pay you 5% per year, guaranteed, backed by the US government for 10 years, a 30-year fixed mortgage is going to have to pay, it's going to have to cost you, pay the investor more than that, because otherwise, why would they lend you their money, right? If they can have their money guaranteed by the US government at 5%, why would they lend you money for less or equal to 5%? You're way more risky than the US government, I promise you that. So that's like a basic, if you look at the 10-year treasury bond and look at what it is yielding, that is a good benchmark of what rates are going to be. And consumer rates will never be lower. A 30-year fixed mortgage rate will never, ever be lower than what a 10-year treasury bond pays. So that's just one kind of benchmark to look at. There are other issues at play, but that's the general, the general thing is that when investors are looking at where they're going to put their money, if you're going to invest your money, you want it to be the least amount of risk, the most amount of reward as possible, right? So, if you can get your money guaranteed by the federal government, you're going to do that. If you can get it guaranteed by somebody else, right? Somebody with excellent credit, they put a bunch of money down. It's backed by a one individual house, right? It's riskier than the federal government. It's riskier than the U.S. government's their guarantee. So you're going to have to get paid more, and that's worth it to a lot of people, right? If you can get a treasury bond at 4%, get an extra 2% on your money on 500,000, it adds up over time, right? So that's just the nature of markets. But it's my advice: don't try to armchair quarterback the the U.S. financial markets. I've been looking at this stuff every day for 15 years, and I don't have a deep enough understanding to predict where interest rates are going to go at any given time. So I definitely suggest that nobody else tries to do that either.